Money is not breaking, it is being stretched to its absolute limit. And when something this complex gets stretched too far, it doesn't just bend, it snaps. For decades, the global financial system has operated like a carefully balanced machine. Banks lend money, governments borrow, markets rise and fall, and central banks step in when things get unstable. But beneath that appearance of stability, something far more dangerous has been building. A silent accumulation of risks, layer upon layer, debt upon debt, liquidity stretched thinner than ever before. And now, all of it is starting to move at once. This is not a single crisis. This is a financial superstorm. On the surface, everything appears controlled. Stock markets still function. Governments still issue debt. Banks still operate. Central banks still announce policies with confidence. But this sense of control is fragile. Modern finance is not built on cash, it is built on trust. Trust that institutions will honor their obligations. Trust that debt will be repaid. Trust that markets will remain liquid. Trust that nothing will break all at once. But trust is not a constant. It is a sentiment. And when sentiment shifts, systems collapse. At the center of this storm lies one undeniable reality: the world is drowning in debt. Governments have borrowed aggressively for decades. Businesses have leveraged themselves to expand. Households have taken on mortgages, loans, and credit obligations. This debt was manageable when interest rates were near zero. But that era is over. Now, borrowing costs are rising. Governments must pay more to service their debts. Corporations face higher refinancing costs. Consumers are feeling the pressure through higher loan payments. This creates a dangerous feedback loop. Higher interest rates lead to higher debt payments. Higher debt payments reduce spending. Reduced spending slows the economy. A slowing economy increases default risks. And as defaults rise, confidence begins to fall. This is how financial stress builds. Quietly. Gradually. Then suddenly. In finance, liquidity is everything. Liquidity means how easily assets can be bought or sold without causing major price changes. When markets are liquid, everything works smoothly. When liquidity disappears, chaos begins. Today, liquidity is under pressure. Central banks are no longer injecting unlimited money into the system. Instead, they are tightening. This removes a crucial source of support that markets have relied on for years. At the same time, large financial institutions are holding massive amounts of assets that are difficult to sell quickly without losses. This creates a fragile environment, because when a crisis hits, everyone tries to exit at the same time. And when everyone tries to sell, prices collapse. Bond markets are supposed to be the safest part of the financial system. They represent loans made to governments and corporations. Traditionally, they are stable, predictable, and low risk. But that stability depends on one thing: confidence. Recently, bond markets have shown signs of stress. Yields are rising. That means investors are demanding higher returns to hold debt. This signals increasing concern about risk, inflation, and government finances. When bond yields rise sharply, it has a cascading effect. Borrowing becomes more expensive. Government debt becomes harder to manage. Corporate financing costs increase. Mortgage rates rise. Economic activity slows. Bond markets are not just another asset class. They are the foundation of global finance. And when that foundation cracks, everything built on top becomes unstable. Beyond traditional banks lies a massive and less visible system known as shadow banking. This includes private credit funds, hedge funds, and non-bank lenders. Unlike traditional banks, these institutions operate with less oversight. They take on risk, lend money, and move capital, but often without the same regulatory safeguards. Over the past decade, this sector has grown significantly. Why? Because it offers higher returns. But higher returns often mean higher risk. The danger is not that shadow banking exists. The danger is how large it has become. In a financial crisis, these institutions may not have the liquidity or capital buffers to absorb shocks. And if they fail, the impact could spread rapidly through the broader financial system. The modern world depends on global trade. Supply chains stretch across continents. Raw materials come from one country. Manufacturing happens in another. Products are sold globally. But this system is under pressure. Geopolitical tensions are rising. Trade routes are being disrupted. Countries are prioritizing national interests over global cooperation. This is creating a fragmented global economy. And fragmentation leads to inefficiency. When supply chains break or slow down, costs increase. When costs increase, inflation rises. When inflation rises, central banks raise interest rates. And when interest rates rise, financial stress intensifies. This is how economic pressure spreads. Not through one event, but through interconnected systems. Markets are not just driven by data, they are driven by psychology. Fear can spread faster than facts. When investors lose confidence, they begin to act defensively. They sell assets, they move into cash, they reduce risk. This behavior is rational at an individual level, but when everyone does it at the same time, it becomes dangerous, because mass selling drives prices down, and falling prices create more fear, which leads to more selling. This cycle can turn a manageable correction into a full-scale collapse. History has shown this pattern repeatedly. From the Great Depression to the 2008 financial crisis, panic has often been the final trigger that turns instability into disaster. Central banks are the backbone of modern financial stability. If they lower interest rates, they risk fueling inflation and asset bubbles. There is no easy solution, and this creates a dangerous situation where central banks may not be able to prevent a crisis. They may only be able to manage its impact. The most dangerous aspect of this superstorm is not any single risk. It is how all the risks are connected. A shock in one area can spread rapidly across the system. For example, a geopolitical conflict disrupts oil supply. Oil prices rise. Inflation increases. Central banks raise interest rates. Borrowing costs rise. Debt becomes harder to service. Defaults begin to increase. Financial institutions lose confidence. Markets sell off. Liquidity dries up. Panic spreads. This is not speculation. This is how systemic risk works. And when enough pressure builds, even small triggers can cause large-scale collapse. This storm is not theoretical. It is already forming. Bond yields are rising. Debt levels are at historic highs. Liquidity is tightening. Markets are volatile. Geopolitical tensions are increasing. Private credit is expanding. Financial institutions are exposed. Individually, these are manageable. Together, they are dangerous. Financial crises are not new, but each crisis has unique characteristics. What makes this moment different is scale and speed. Global markets are more interconnected than ever before. Information moves instantly. Capital moves instantly. Fear moves instantly. This means that if something breaks in today's financial system, it can spread faster than at any previous point in history. Modern finance is deeply interconnected. Banks, markets, and economies are all linked through complex networks of credit, trade, and investment. Because of this tight integration, a disruption in one area doesn't stay isolated. It travels quickly across borders, industries, and institutions, turning a small issue into a global problem in a matter of moments. Behind every chart, every percentage point, and every headline number are real human consequences. Jobs can disappear almost overnight. Life savings can be wiped out by falling markets or failing institutions. Businesses that took years to build can collapse under financial pressure. Families may struggle to pay for basic needs as incomes shrink and costs rise. What often looks like a technical financial event is, in reality, a deeply human experience. And when that crack appears, it can widen rapidly. The financial superstorm is not a single event that arrives suddenly out of nowhere. Instead, it is the result of years, sometimes decades, of accumulated pressure. Rising debt levels, tightening liquidity, geopolitical tensions, shifting market psychology, and evolving policy decisions all build upon one another. These forces do not act independently. They converge, interact, and amplify each other. The real question is not whether the system will be tested. It already is. The global financial system is constantly under stress, adapting to new challenges and balancing competing forces. The true uncertainty lies in how it will respond when that pressure becomes too much to contain. Because in finance, as in nature, storms do not announce themselves. They do not arrive with warning signs that are easy to recognize in real time. They build quietly, often unnoticed, until their effects become impossible to ignore. And by the time the strength of the storm is fully realized, it is often already too late to prepare. This is just the beginning. Subscribe now, because what comes next will change how you see the world.